Welcome to the Aramir Roundtable. I'm Tom Unamaker with our guest Scott from StratagemTrade. Welcome, Scott. Nice to have you back.
Thank you for having me.
And before we get too far into it, there's a normal disclosure that we're not a broker-dealer or investment advisor. This is for educational purposes only. Options involve risk and are not suitable for all investors. Past performance is not indicative of future results. And if you want to read the whole disclosure, just pause the video or go to the bottom of our websites. So we'll go and stop the recording right now, and we'll switch screens. All right, so we're back with Scott's screen, and just so you know, Rolling Thunder is actually getting kind of popular in our community. I've been singing the praises of it, and I think it's a great trade. I really like the book a lot, and I'm sure everybody's really going to enjoy this. So take it away, Scott. Nice to have you here.
Thanks, Tom, and hello, everybody. We too have disclaimers. It's pretty much the same thing verbatim as Tom's, because when someone's got a better idea than us, we take it. So his disclaimer was better, so I think we borrowed a sentence or two from his, but for the most part just says we're not a broker dealer, and any trades people see from us are for example purposes only and don't copy it. I want to thank Tom for making this possible. He's been one of the greatest partners we've had. He's the most easygoing and dedicated people that we work with, and so thanks, Tom.
You're welcome.
By participating any further, you just are implied that you're agreeing with the disclaimers. And just to let you know who I am, for those who didn't hear me speak once before, I started trading on the floors in about 1985. And I spent most of my time as a member of the CBO, even though I'd been on the Merck floor and the Board of Trade as well. And I left the trading floors in about 1996 when a lot of professional floor traders were leaving because the floors were dying down and the technology was getting so good at home from brokers like Thinkorswim and others that there was no advantage to being on the trading floors. So why fight traffic and push and shove when you can trade in your underwear in your living room? I've been slowly going from full-time trading to also teaching as instructor at Trade Secrets, the head instructor at Optionetics, and then my own company. Some of you guys may have seen me at Oasis at Optionetics, where I've been speaking in front of as many as 2,000 people at a time. I wrote over 16 textbooks. I don't even remember how many I've written. But I've been in Stocks and Commodities magazine, CNBC, Wall Street Journal, etc. And I started Stratagem 2 years ago from my other company called Random Walk, that some of you guys may have heard of, only because my partner and I had a fundamental disagreement on how to handle trading and sales and everything else like that. And it was just time to go our separate ways. So I started Stratagem. I've written the book, the original book on broken wing butterflies, which then caught the attention of Stocks and Commodities magazine. And they said basically my books were the Bibles of option trading. So I think it's a little bit more flattering and than than it really is, but I'll take it. But those are the different pits I've been in. Most of the time I was spending in the bottom screen, which is the S&P 500 pit on the Chicago Board of Options Exchange. I don't know how. Okay, as far as Rolling Thunder spread is concerned, it's a very, very kinetic strategy in that there's a lot of different things you can do with it. If you're a very laid back trader and like to position and hold things, it can be done that way. But for those people who like gamma scalping type of trades, this can get very, very fluid and you can make a lot of adjustments, and it satisfies your wanting to tweak positions to try to scrape out a little extra here and there. But most of the time it's used as a hedge. Most of the time my company demonstrates this as a hedge for declining markets. For the last, I'd say 5 years, and teaching option strategies and having people follow my trades, I've been carrying bullish deltas because we're in the biggest bull market in the history of mankind, in the longest running bull market. So why not carry long deltas, but always be hedged? And this is a great strategy for those people who like carrying long deltas, long stock for their retirement accounts, what have you, and the hedge for declining markets without just wasting money every month buying a put or doing a collar and limiting your upside, because the objective of this trade is to eventually get into your hedge for close to zero debit. But other people have been using this to make money on the downside, and a few people who are very aggressive use the strategy to even create a bullish position. It's easier to implement with puts than it is with calls because of the skew in the index options, but it can be done with both calls and puts. And lastly, in this type of market where we've been getting day after day after day of downward movement, it's easy to stack trades on top of one another. You implement a rolling thunder trade and you get it nicely hedged off where you have this giant range of profitability. But when the S&Ps are moving 100 points in a 2-day period or even a 1-day period, it's easy to go through all the strikes, so you just add another layer below the original strikes. And this statement will make more sense in a minute. So as I said, there's 2 ways to play this. You can use it for a hedge against long deltas, which is the most common use, or you can use it just as a individual bearish trade. So in order for this to make more sense, let's just get on with the slides and with what the strategy is and what rolling thunder looks like. Now, the key to the strategy is real simple. Here is the SPX. And let's say you want to make money in the downward movement that we've been having, or you just want to buy protection for long deltas. The problem is you'll often see, in anyone who's ever hedged long stock, like say own Apple and then buy an Apple put just in case the market falls, and created a married put type scenario or a collar scenario, is the market falls, the put you bought as a hedge does a great job hedging, it inflates in price, but then the market bounces and that put you bought for $1 that goes to $3 or $5 or $10, then eventually goes out worthless and you don't capture any of that money. Rolling thunder is a way of trying to capture some of that money. And it happens a lot in this type of market where for 2-3 weeks, the market will fall maybe say 7%, 10%. And then all of a sudden, in a matter of a couple of days, it bounces. If you go and look at a graph of the SPX for the last couple of years, you'll see that most of the time the market bounces or falls, it'll have an equal and opposite, almost Newtonian type of response. Even during 9/11, when the market fell because of the planes hitting the World Trade Center and the Pentagon, we had a giant drop. And in almost exactly the same amount of days that it took for the market to fall 1,000 points, we bounced the same distance in the same amount of time. And you get this V image. And this was just back in October. We had a 7% drop and we bounced right back 7%. what is very frustrating to people who buy puts as a hedge is that they'll hedge their stock. The stock will fall, the put will blow up in value to offset most of the loss from the stock. But then when the stock bounces, the put goes out worthless and you're back to where you started with the stock. I mean, has that ever happened to you guys where you buy a stock at 100, you buy a put, the stock falls to 90, the put goes to $10, and a month later the stock's back at 100 and the put goes out worthless, and basically the whole month nothing happened net. You had all this movement, all this kinetic energy, but none of it was harnessed for any P&L gain. And the great thing about Rolling Thunder is that the debit from the purchase of that put or that put spread won't expire worthless because we're trying to get into this hedge for close to zero anyways. On this image, what you see is a graph of the SPX. And back in the beginning of, well, in the middle of October, the market fell. And if you owned a put spread like you see on the left of the screen, the market may have gone all the way through the put spread, been deep in the money, and then 2 weeks later, the market bounces and that put spread goes out worthless. Rolling Thunder is beautiful in the fact that we're trying to always get the cost of that hedge back. So you have a hedge on, but it's not costing you anything. And I guess a good analogy is, how cool would it be if I could show you guys how to get your car insurance for free? How much would that save you over the course of your lifetime, where the $2,000 a year you pay for car insurance gets paid off, where it becomes free? How much do you save over those years? And that's an oversimplified way of the goal of Rolling Thunder. And I'm just going to give you guys the best way of understanding this through example. And I'm going to give you a garden variety example that we have currently in pot class right now, that of a Rolling Thunder trade that expires with the the December 24th expiration. And this was done in our pot class, and especially nowadays with all the marijuana stocks taking the headlines, I have to explain what is our pot class. Okay, so that you don't think this isn't a marijuana stock, but our pot class is just really, we call it practical option tactics. It's a once a week class on Wednesday nights. That's done over the computer, sort of like we're doing right now. But I also find examples of a variety of different strategies and put on examples when I think it's appropriate for the market conditions. So I'll put on an example and then we'll follow it, whether it makes money or loses money. I'll follow the adjustments and everything else, because we found, at least for our students, that the best way of learning things is through example and actually getting as tangible as possible. So this is held every Wednesday night at 6 p.m. Chicago time, and we do actual trade examples in a portfolio so that people can see what we're doing, what kind of strategies we're doing for various conditions. So it has nothing to do with marijuana stocks, but with we have, I think, 3 Rolling Thunder examples right now because of how much the market's been falling of late. Every day, President Trump tweets something and the market falls. And then he'll reverse himself and the market bounces. But net, since October 3rd, when the Fed chairman of the Federal Reserve made a comment about interest rates, the market's been falling from SPX 2900 to 2600. And The Rolling Thunder trade example I'm about to show you has several pieces, but we initiated it in 3 different steps. The first step was on December 4th. We entered into a large put spread. As the market was falling, on December 4th, we went into the SPX and bought the 2700, 2680 put spread. It's $20 wide. The market was a little away from 2700 at the time. It was probably 2735-ish. And we paid $5.10 for that $20 wide put spread. Now, once you get on a put spread, if that's your only position, your stance is you hope the market goes down below the furthest out of the money strike so that you can make money on said put spread. If the market closes below 2680, we make $20 on this put spread we spent $5.10 for, and you made close to $15,000 on these 10 spreads. The problem is, if we're hedging our long deltas, you become almost bipolar in your response. You want the market to go higher, so your long deltas make money, but then this put spread you spent $5,100 on will expire worthless, and you're a little upset about all those premiums going out worthless. So with the Rolling Thunder strategy, we're trying to come up with a wide spread that gets our debit down to 0. And this is the first step. On December 4th, as the market was falling, I entered into this $20 wide put spread. And now my concern is, what if this $5,100 of hedging that gets me to Christmas goes out worthless? I've decreased my gains by $5,100. I have long deltas. If the market goes up, I'll be happy, but I better make more than $5,100 to offset the cost of this spread. So how do I get some of this $5,100 back? And you guys already probably figured out, you got to sell something else against it to get some of this premium back. Take this long put spread and turn it into a butterfly, turn it into a condor, turn it into something. And that's what we did. We have this cognitive emotive dissonance going on of, do we wish the market to go lower or higher? Is this market going to bounce right when we get our insurance on? Or is it going to continue to fall? If the market's going to continue to fall, we don't want to sell out this put spread because we need it as a hedge. But if we bounce, we're going to be giving away $5,000 in insurance. So as soon as the market began to fall again, what did we do? We decided to spread it off. So this is a little bit, and it's really sounds like we're just legging into condors, but it's more of a process than just legging in the condors. We're not taking bets on market direction. So by the end of the day, the market continued to sell off. And what did we do? We took some of the premium back by spreading some of it off. Being long this put spread in itself offers close to $15,000 of protection, but we're always going to be staring on the other side of the equation, like what happens if this market bounces and I lose this $5,000? And this is the graph, the profit and loss graph, the P&L graph of just the put spread. And you can't help but having that focus on the negative right there of, if the market closes above 2,700, or actually 2695, the break-even point, we're going to lose $5,000. So the next step, step 2, is to start getting back some of that original outlay. And what we did is, after the market fell a little bit more that day, we went in and sold 30 contracts of a $5 spread. Now, you can sell 30 contracts of a $5 spread without having huge margin if you have 10 contracts of a $20 spread above it. On the 10 contracts of a $20 spread can make 20 grand, and 30 contracts of a $5 spread that you sell can lose 15,000. So if you can make 20 grand on the way down and lose 15 grand below it, you're still net profitable $5,000. And so depending on your broker, you may or may not have a huge margin. With Thinkorswim that we use, or Tastyworks in the United States, they consider this a no margin type trade other than your original debit. So it's not really costing you anything other than your debit. Now, other firms are a little bit more punitive and will increase their margin greater than risk-based margin, but it's just something you have to work around. But if I sell 30 contracts of the 2650, 2645 spread for $1.40, 30 times $1.40 brings in $4,200. Now I've gone from $5,100 debit, taken in $4,200, and my debit is down to $900 instead of $5,000. And if you look at the timestamps on these fill prices, you'll see that it was, most of the risk was then eliminated the same day, just a few hours later. And the resulting profit and loss graph looks as follows. Now, looking at this arrow, you see a greatly lowered amount of dollar risk. We've gone from 5,100 down to $910 or $900 of risk. And our actual profit potential has gone from just under 15,000 closer to 20,000. Our profit potential has gone up because of the money we've taken in. However, the range at which we make that full amount of money has decreased, and we're only making the max down to 2650. With just the put spread, we're making our maximum all the way to zero. Here at 2650, we start giving some of it back, but even then, below 2650 and 2645, which is the tail end of our short spread, we're still going to make $4,100 if the market goes all the way to zero. And you have to ask yourself, is $4,100 enough protection in a down move? If not, we'll add another layer to this later on as needed. But let's forget about that for now. We started out with the purchase of a put spread. We sold some put spreads against it. We turned it into, from a purchase of 10 wide spreads and then a sale of 30 smaller spreads, which is typically how we deal with this because of the skew in the options. But we could have turned this into a butterfly. We could have turned it into a standard condor where we bought a $20 spread and sold a $20 spread against it. Essentially what we did here is bought a $20 spread and sold a $15 spread. It's another way of looking at how we sold 30 contracts of a $5 spread is essentially equivalent to selling a $15 wide spread. And this little submarine type graph in green is the resulting P&L graph. The purple line you see there is the P&L graph prior to expiration, which I don't know how our broker came up with that P&L graph of being able to lose close to 15,000. I don't know where it's coming from because it's not an accurate. There's no way once we had these two positions on, we can lose anything more than our original debit of $900. But I don't know how to get rid of that line in the graph either. So the green line is what we have to focus on. That purple line is some erroneous information getting in there somehow. So this was step 2. Now, once we have this position on, I'm looking at my maximum profit and the range at which I can make money. I'm essentially good from 2,700 down to 2,645-ish, which is a pretty big range. It's 550 Dow points. Is that enough protection? Well, up until maybe October, that was a pretty decent range, 2% range. We weren't falling more than 2% a month. Now we're doing 2% movements every single day. So I'm going to be adding another layer to it eventually. But under most market conditions, this would be unbelievable amount of protection. But even if we fall through that 2% range of 2,700 to 2,645, 2,650, if we keep going through it, I still have a decent amount of money I can still make on this trade. The negative of this trade is it's costing me $900 still. Now, for each individual, you're going to have to make an assessment. Is that too much money? Are you willing to accept the $900 investment to have this when essentially the market's at 2,700? For those who understand the normal distribution curve and how it works, when the market's at 2,700 and you have a graph that looks like this that starts at 2,700, it's essentially a 50-50 proposition statistically if the market's going to go lower or higher. Anybody looking at this graph would probably be very content paying $900 for this trade, knowing that 50% of the time the market's going to go higher and you're going to lose $900, and 50% of the time the market's going to go lower and you're going to make at least $4,000, and you could make up to $19,100. I would do this bet in a coin flip any day of the week. But depending on each individual, some of you guys may want to tweak this a little bit more and get that original $900 debit back so you're into your hedges for zero cost. And I asked my students, do you want to keep this position on like it is right now? Do you want to add another layer? Or do you want to get that $900 back, but lower the profit potential of this trade a little bit? Because by getting that $900 back, I have to sell another spread against it. And the majority of the group, which is how we work, voted for getting that $900 back. They wanted a trade on that had zero cost to it or a small credit, but still had downside profit potential or a hedge effect to it. So really the question was, do I want to get that last $900 debit back or not? And everybody said, yeah, make this profit and loss graph a little less sexy, but so that we can get the $900 back. So we did a third step. and we sold something to take in $900 or more. And what we did is the next business day, because the 5th, the market was closed. I think it was for President Bush's funeral. The 6th, we went in, the market opened lower, and instead of selling more of the 2650 45 put spreads, we went further out of the money. Because the market went lower, we could lower our strike prices further, and we sold the 2600 25.95 put spread at $1.70. The market had fallen so much that we were getting a better price selling the 2600 25.95 put spread than the put spread from 2 days earlier at the 2650 2645 puts strikes. So an hour and a half into the open, the market was down tremendously. And we sold another 10 contracts, and we figured, look, if we're long a spread that starts at the 2700 strike, and we sell a spread that starts at the 2600 strike, that's 100 SPX points difference between my long and short. That is a huge range for something that's 20 days until expiration. Huge. That's 1,000 Dow points, essentially, between my buys and my sells. It's a pretty good bet. So we sold that. And now what we're into in the 3 different pieces, and in this example, it was example number 275. So far since January of this year, in our pot class, this was the 275th example. We start every year with trade 1, trade 2. This trade was our 275th example for the year. And what you see is part A was the purchase of the long put spread, part B was the first sale, and now part C is the third part of the trade, or the second put spread sale at the bottom, where we sold the 2600 25.95 put spread for $1.70. And what you see in the highlighted shaded area is that we now have on a trade for an $800 credit. Okay, we have on this position, the submarine type shape. I don't know how else to describe it. I mean, I guess it's sort of a Rorschach exam. Everybody will see a different shape. To me, this looks like a submarine coming out of the water. But for $800 credit, we have on this. Where do you lose money? Again, ignore the purple line. I don't know where that thing is coming from. It's the green line that's making sense. And that's our P&L graph at expiration. We can make $20,800. And if the market goes below all the strikes or above all the strikes, we still make $800. How cool of a hedge is it when you're paid $800 to have on $20,000 worth of protection, or $5,000 worth of protection, or $6,000 worth of protection below that giant hump? In a 1,000 Dow point range, no matter what happens below 2,700, for 1,000 Dow points lower, we make up to $5,800. Now, again, it's a very democratic process, our pot classes. Our students tell us what they want to see. And we ask, leave this alone, tweak it. What do you want to do with it? And I'm going to be doing something else with it. added another one of these rolling thunders in a different expiration after this. In other words, once this example was done and we had this graph, people said, how about a different expiration? Get something like this in a different expiration so we have a better chance of, whenever expiration we have on one of the days, the SPX will settle somewhere in this giant P&L range. Because too many times we'll see the market say settle, let's say the SPX is at 2650. If you run from the bottom at 2650 all the way up, the day of expiration, you see that we make over $20,000. But if we fall a couple points, our maximum profit drops. Or if we have a 50-point up day, we give back all that potential profit, put it on several expirations so that we are diversifying our expiration risk. And so after this one, we added on another trade, another rolling thunder trade, and another. And as a matter of fact, I'm taking one off today in the SPX that expires at the end of the day, where our maximum range is, I think, I got to look at it. I have some trades on, but I don't want to say the wrong thing. But it is, I believe, between 2675 and 2640. But again, that's just going off of memory. Anyhow, our student said add another expiration. So instead of adding to this position, we went and created another one. But what we typically do once we have one of these trades is then add another layer and then add another layer in the same expiration. This time our student said, let's go into a different expiration. And what you see is with a rolling thunder trade is it becomes a process. It's not necessarily just a strategy, but it's a fluid process of continually enhancing trade. Especially after you get on that first trade and have the market move a little bit in the direction that first trade benefits from. In other words, we started with the put spread, and once we got a little movement lower, then it was game on, and we can play with it. If the market bounced, we would have done something else, and that's outlined in the book. But once you get your first hedge off, then you're golden. You can keep playing with it, and it becomes either a standalone trade for those people who don't want to bother with it. You've got a hedge on dirt cheap or for free, and you just leave it, or you can start tweaking it and adding to it. And what we typically do is, especially in a market like this where we're continually falling day after day after day, is we'll add another submarine or shark fin. And we just lower the market goes and we add to it. So what you see here is a previous example we did where we just kept adding to it. The first pump on the rate, 2690, 60 anything eventually. Then as the market fell, we added another one at the 2050 strike all the way down to the 2025 strike. And then as the market fell, we added another layer and another layer. Now, what's really cool about the rolling thunder strategy is look at that blue line. Let's say you go out and spend $5,000 because the market keeps falling. And you add another layer and you add another layer. And then the third layer is a put spread you start and you spend $5 on, costs you $5,000 on 10 contracts. And the market bounces. And you have on what you're considering a naked put spread. What's your concern when you buy put spread and the market bounces? The concern is that that premium you spent is just going to evaporate. But it's going to evaporate if the market does what? Bounces. And if the market does bounce from, say, SPX 2000, what's it going to do? It's going to go through 2030, 2040, 2050 higher. And there's a good chance that we'll settle in one of these green shark fins or teepees and make $5, $10, $15, $20,000 that pays you back for the premium of that last put spread you bought. So when you add, I guess the best way of saying it is, once you add that first layer on, you decide to add a second layer. The first layer is protecting all the risk of the second layer. Because if that blue put spread goes out worthless, because the market's going higher or to the right of the screen, we have all these put spreads on that the market can settle at and pay us back a $5,000 loss. And I hope I explained that correct, Tom. I mean, it's something difficult to explain without animation tools available. And I don't know if people can see my cursor, but basically, if we're at 2000 and the market bounces 2035, 2040, let's say market bounces to 2040, I'm going to lose $5,000 on that last put spread. But a previous Rolling Thunder trade at 2040 makes $10,000. So that pays me back my $5,000 from that last put spread. And I guess the easiest way to say it is each additional layer is being protected by the previous layers. So if we bounce, not only are you going to make money back on your long deltas, but on a previous layer of the Rolling Thunder. And so you can just start stacking this real easy. And if the market bounces, hopefully it settles in one of these other TPs that helps pay you back for that last leg that didn't work out. Anyhow, it begins to start feeling almost like magic compared to the neophyte or beginner's way of hedging a stock or a portfolio that we learn when we're first learning options. When we first learn options, you learn buy a stock and then buy a put, and you have a married put on, which is a synthetic long call. And you're like, this is pretty cool. I mean, if I buy Apple at 230 and the stock falls to say 170, I don't lose 50 bucks. I just lose the price of the put. Yeah. Well, this is, if the married put is the beginning of your education, it's almost like you're playing checkers. Now you're playing chess, because we're not going to be losing that debit our hedges normally cost us when it doesn't work out. So it really becomes feeling like magic. Now, a lot of people from Irmer have already bought some of our books, and I hate to sound like I'm making a commercial interruption, but it's really not that as much as just a little bit edification, because we offer everybody at Irmer a 10% discount, and some people just find our website and don't realize you guys get a discount because of Tom. And so we offer you guys two things. Just for participating today, you get a 1 month free subscription to our POT class that I talked about. Come and watch for a month. It doesn't cost you anything. It's usually $299. Again, every Wednesday night at 7 p.m. Eastern or 6 p.m. Chicago time, we have a 2-hour class like I'm doing right now. Hang out for a month and see some of our paper trade examples. It's completely free. All you do is go to admin@StratagemTrade.com, and one of the girls in the office will be happy to sign you up. But also the Rolling Thunder book. And I think Tom is the only one we offer this discount to. Your group, Glenda, my office manager, handles all this stuff, so she would know better. But I think you guys are the only ones we give a discount to. We've had a lot of people from Irma buy our products and not take advantage of the discount code. And we had to go back and figure out, oh, you know what? They're from Irma, and we just credit their credit card 10%. Well, there'll be a discount code box if you decide to ever buy anything from us. And you guys get the 10% discount that Tom negotiated on your behalf. Again, I'm not trying to push the sale of the book, buy it, don't buy it, whatever. Take advantage of the pot classes for free. We're not a salesy firm like most people in the education industry. I don't try to talk anyone into a sale. If you don't want to buy anything, don't buy it. I prefer you didn't buy it because I don't want to deal with people who feel like they got forced into something like some of the other firms I talked to that were high pressure sales. As a matter of fact, I think this is the most amount of sales I've done in the whole year combined. But I want to thank Tom, and now's a great time for questions and answers on this strategy. Hopefully it makes sense, but I also have a half an hour of Q&A that Tom's afforded me for anyone who's got a question. Okay, I see the first question. I'm hoping you guys can still hear me. The first question is, what action will you take if the market moves upwards? Okay, and that's a great question. And hopefully you can still see the slides. And I'll go back to a different slide and answer the question. Now, there's a lot of things that you can do if this. I assume that the question is, what happens if you buy that 2,700, 2,680 put spread and the market goes up? What can you do? Now, that's a great question. And there's really two different ways to answer it. First of all, if you're doing this trade as a standalone trade, meaning you're not trying to hedge any long deltas, you have an empty account, it's tabula rasa, and you're trying to make money on the market falling, and you enter into this put spread. That's a different question than, let's say you have 100 SPX deltas or 200 SPX deltas that are long, or a portfolio of stocks. You have long call spreads in Apple and long deltas in Netflix and long deltas in Amazon. And instead of hedging each individual name, you decide to just go into an index to hedge all of these because of the systematic risk of the market. If the market falls or FANG stocks fall, it's going to take down the SPX. So why not just hedge them all with the SPX? If you have, say, 100 long SPX deltas or 200 SPX deltas, and you buy this put spread and the market goes up, it doesn't take a lot of movement higher in the SPX to make back that $5,000 with all those deltas in Netflix, Apple, or just in the SPX itself. It's almost like looking at the trade as, I'm long Apple, so I'm buying an Apple put as a hedge. Hopefully, I lose everything on those puts in Apple because the stock has gone up so much. If my puts cost $1 and the stock goes up more than $1, I'm at break even and start making money. That's another way of looking at it. But let's say you buy the 226.80 spread, and instead of the market falling, it goes up. What do? This happens to me. This does happen to me. When you're reading the book or looking at any of the classes we recorded on this strategy, it talks about that, but in a great detail with all the different choices you have. But just real simple because we're limited on time. I can always just move those strikes up a little bit and turn it into a different trade, maybe a condor type thing. Or instead of moving my spreads as far out of the money as possible, I can move all the strikes down a little bit. I go to, say, instead of where I went to next at the 2650, 2645 strike, I just go down to the 2695, 2675 strike and sell a $20 spread, one strike lower. And what I'm going to turn this into is a condor for a small debit. In other words, I'll sit there and I'll put this order on for, say, $5. And if the market bounces and I'm worried about losing this $5,100 or $5.10, I can sell the 2695, 2675 put spread against it, another $20 spread. It may be $4.50. Into this trade for 60 cents, but have on a condor for 60 cents. And it'll still be a 60 cents at risk instead of $5.10 at risk, but it's only 60 cents. With 60 cents on 10 contracts is $600. You don't need a lot of SPX deltas for you to make back $600 in the SPX over the course of a month if the market goes higher. And if the market stays flat, you have on an at the money put condor. It's not ideal. You're going to still be into it for a debit, but it's still a much cheaper debit than most people who don't understand this process are paying for their hedges. Now, the other question I have is, but if you make, once you have on adjustments 2 and 3, you're unhedged. Okay. Let's go back to the graph of 2 and 3. Here's the graph of, or the original trade after the hedge 2 and 3 are put on, and this is the final product. Am I unhedged? Well, let's look to the right. Let me see if I can move. Now look at it on the right. You see that giant arrow on the right? With the market at 2,700 and falling, and looking at this green P&L graph, I would say we are hedged. If I make the adjustments 2 and 3, I am no longer unhedged. I've got on a great hedge. Sure, if we close at that left area, I'm only going to make 5,800, but I still have 5,800. If we move further down, I still make money. Even if we go all the way to the end of my break even on this thing, which is about 25.95, I don't lose anything. And hopefully on the way down, I'm adding another layer so that eventually the trade just keeps looking like this, where the more we go down, the more layers I'm adding to it. Another question came in. Your voice sounds familiar. Did you used to be with another firm? And if so, yes. Which one? Well, I was in charge of the speakers at Optionetics, all the traders, for about a year, for close to 2 years. I used to speak on the main stage at their annual event, Oasis. So a lot of people saw me there because they'd have over 2,000-3,000 people there every year. I've spoken at a lot of places. I teach at Northwestern University once in a while. So if you went to Northwestern University, that's where you may have heard of me. And I also am owner of Random Walk, though I have nothing to do with it, I still own a chunk of it. So if you heard me from maybe Random Walk, I teach in Italy a lot. So if you're an Italian student, you might have heard me there. I was on CNBC in Italy. So you might have heard my voice on TV from European TV. I don't know. One of those places, the only place you would have heard me, though. Any other questions, Tom? That I didn't.
Yeah, there was one. Is pot real money or paper money? I think it's paper money, isn't it?
This is paper money, and the reason we do paper money in our trading accounts is not that we're afraid. I wish we were doing real money, okay? But you enter into all kinds of SEC compliance issues in terms of using real money. In other words, what if I do a trade and I send out an email to everybody? Because every time I do a trade, I send out an email to people within a minute and say, this is the trade I'm buying. And then all of a sudden, everyone starts buying it. What am I really doing? I'm essentially front running the trade and having everybody else behind me prop up my trade financially. And it's called front running, and it's a big bozo no-no. And I don't want to be ever accused of front running trades. And, you know, that's what these big firms like Morgan Stanley, Goldman Sachs, and, you know, really upset people do is they go out and make a recommendation after they already bought it and it supports their trades. Or, you know, even worse, they go and make a recommendation to say buy as they're selling. The only reason they're making a recommendation to buy is to get everybody to go in and buy and be able to create liquidity or inflate the price of the stock so that when they sell, they can sell at higher prices. And it creates all kinds of conflicts of interest. And to avoid all that conflict of interest, we just use the paper trading account system.
Okay. There's another question about, can you explain how to balance rolling thunder versus existing positive delta position? I don't know if you answered that. I don't think so.
Oh, I didn't even see that one. I'm sorry.
Okay.
That becomes a somewhat subjective. That's a great question, by the way. That's a really good question, and that's almost the $64,000 question: is how big do you get in order to balance out your portfolio? Let's say you have an SPX delta of positive 100 deltas. How big of a position do you enter into to hedge that portfolio? And it's spelled out in the book in great detail, but just real quickly, there's a down and dirty way, and accountants and very anal people hate because it's just down and dirty and it's not like to the penny. But let's say you have on 100 long SPX deltas, and the most the market is going down is 50 points in any given expiration cycle. Now, this right now is a unique time, guys. We haven't had this kind of volatility in a long time. For years, the market hasn't moved 50 SPX points, you know, in the expiration, other than to the upside. The fact that we're going down 50 or 90 SPX points in a day, day after day, is rare. And once you start seeing that happen is when we typically add another layer. Under normal circumstances, I'm just going to say, what is the market normally doing in an expiration cycle from a high to a low? And if I'm saying 50 SPX points, okay, real simple. How much money do I have to make to offset my delta's going 50 SPX points against me. If I have 100 deltas times 50, it's going to be a $5,000 loss. I'm going to want a position on big enough to offset a $5,000 loss or more. If I'm feeling like we're in a channel and entering the downside of the channel, maybe I want to make some money on the downside. Say, how big do I get to maybe offset my maximum loss under normal circumstances and then make a certain amount of money? Let's say I want to make $5,000 this month if we go down 2%. And then I just build or create the position based on that. How many contracts do I have to do on a $20 put spread to make $5,000 if the cost of the spread is $5? Well, if I have a $20 wide spread that costs me $5 to start with, I can make $15,000 on 10 contracts. I probably only need 3 contracts to make $5,000, and I'll start that way. Just reverse engineering it. Now, under normal circumstances, that works. But what happens with all of a sudden the market goes crazy and we start like getting news that Chairman Powell's going to get more aggressive with interest rates, and President Trump is getting more aggressive with China on tariffs, and we're maybe shutting down the government over funding of the Mexican border wall in the United States. And it's creating all kinds of volatility that you couldn't foresee before you put the trade on. Well, then I just add another layer, and I've been doing that. You know, I started out with trade 275 back in December 4th. Once we got this cleaned up, we went in and started doing another one. Every day the market's been falling, we've been looking to maybe do another one. And once in a while we will add more if it looks like we're about to go through bottom strikes. In other words, when the SPX was at 2,735 and falling, I entered into what eventually became this. All of a sudden the market's at 2650, 2630, 2620. I'm about to exit the range of profitability on this trade. Is that acceptable to me or not? Well, I'll tell you what, if you're not afraid of the market falling, wait until the SPX goes from 2,800 to 2,700 to 2,600, and you'll start thinking 2,500's next. You'll start getting nervous and saying, you know what, we could very easily go through the tail end to the left of this. I better start with another trade. And then I'll just keep adding more and more. Under most circumstances, I have something like this on, and this is sexy enough and adequate enough protection under most circumstances. But in this market, it's not enough. And I'll just start adding another layer or into another trade.
Hey, there was another question too. If they already had a 1 month free look at pot, and can they do it again?
Oh God, I don't even know what our policy is. I think it's 1 per customer, but I try to stay out of all that stuff. I'm too busy, you know, managing positions, managing many different accounts.
Probably best to email
doing the
Glenda.
class and stuff, and I just lead the business end of the business to my office manager. And I believe our policy is 1-time offer, but here's what I'll do. If you already had a 1 month trial, seeing I'm the owner of the company, I can say this: I'll give you another week and then talk to Glenda, the office manager. My guess is it's going to be no, for one reason only, and that's common sense, right? You get 1 month free, and then you ask for another month free, and then you ask for another month free, and then who's going to pay for it? We'll be out of business in a month. So, but I'll give you guys another week, no problem. Just contact the office and tell Glenda or Paulo or Ellie or Rowie or whoever takes your email, that Scott authorized another week. But eventually we have to cut it off or else nobody pays.
Yeah, I want that.
I mean, if you're at the deli and they're giving out free samples at Costco or wherever, eventually you're just going to go to Costco to eat instead of actually buying any of their product. If they're giving out huge samples instead of those little Dixie cups.
There was one more question. Do you balance the next layers in relation to the first one?
For those people who are very anal, it can be done that way. For me, I'm a loosey-goosey type of guy, where a lot of times I'm going off of keeping everything as a strict rule, okay? If I started out with 3 contracts, the next one will be 3 contracts. But if the market's looking really nasty, I'll start adding maybe to the 4th contract or 5th contract. And the reason is maybe to make money on the downside. I may have previously been bullish and now I'm bearish. Now, not only do I want to hedge to the downside, but I want to make money to the downside. But also because what if I see opportunity in acquiring long deltas? It'd be nice to have the hedge on already as opposed to worrying about a hedge later. If that makes any sense, Tom.
Yeah, it does.
Okay.
So how's your book on water coming along?
It will be done at the end of February.
Okay.
It became a bigger undertaking than I thought because originally, most of the books I write, I just find examples online and say, this is a garden variety type of situation. With all the books that I'm doing now, though, I figure I'll just take examples from pot class, so it's almost like a refresher or familiar to people reading the book. They say, "Oh yeah, I saw this in pot 6 months ago." Now I remember, and it becomes more tangible for them. But this has been a hell of a year to find garden variety examples. This has been a crazy year. We went straight up and then straight down, and it's not been your typical year to find what anyone would consider a normal example. Everything's been to the extremes.
And then I guess the last question I've got is, when exactly is your seminar? It used to be in Maui, but this year it's going to be in the Konas, right?
This year it's in Florida, and it's going to be at the end of February. It's going up on our website, I think, at the end of this week. It should have been up already, but I had a little disruption in family dynamics.
You could say that, yeah.
My brother died of a heart attack. My little brother died of a heart attack and then was brought back after 90 minutes of CPR and 17 shocks, and then was put on life support. At the same time, they found a mass in my mom's stomach. She was in for surgery. And then my son, who's an MMA fighter, messed up his back, was in the hospital because they weren't sure if he ruptured discs or not. But he couldn't move. So I had 3 family members in the hospital simultaneously. I was driving from Wisconsin all the way to Chicago and back every day. And pretty hard for the office to communicate with me and make any forward. Basically, I just retarded the forward momentum of the company, which I hate to do, but I always put family first. And so the girls in the office couldn't plan accordingly. But they've got everything under control now. They just don't put anything up on the website, because we learned the hard way, until everything is ironed out perfectly. 1 year in Maui, I think it was about 5 years ago, 6 years ago, we had a hotel. We had a contract with them. We told everybody where the hotel was, so people booked rooms at the hotel, and then at the last minute, the hotel got rented out by the entire hotel got rented out by a company, and us, like every single room in the hotel, every single banquet room, everything. And they basically broke the contract with us and kicked us out and said, we'll make up for it financially and stuff, but you're not going to be here. And meanwhile, students were being kicked out of hotel rooms and sent to other hotels. It became an embarrassment and a nightmare for everybody involved. So until everything is 100% ironclad now, I don't say anything.
Makes sense.
But the details will be out, I will say, by Monday at the latest.
Okay, we had two last questions pop up. Predicted price of water, and how does Rolling Thunder differ from Crash Ready?
Crash Ready is just a little, okay, let me back up and think the best answer. Crash Ready course is a little tiny course. It's almost like an overview of the different types of things you can do if you think the market's going to be crashing. And it goes into just buying naked puts, put spreads, all kinds of different strategies that you can do, and allows you to make a decision what's most appropriate for you. Whereas Rolling Thunder is a very specific, detailed, soup to nuts, very detailed explanation of this type of one hedge. So it's very detailed of this particular process, whereas Crash Ready is very general of many different ways one can hedge in a crash.
Yeah.
Does that make sense?
It does. And
we're dissecting an entire apple instead with Rolling Thunder, as opposed to just taking a bite out of every apple in a whole barrel with Crash Ready.
Yeah, like I said at the start, Rolling Thunder it's a great book. I really enjoy it. I love the strategy, and if people want to learn more, I would highly recommend it. I can't recommend it high enough. I'd say it's almost required reading.
Yeah, well, it's the beautiful thing is I have on one right now that, like I said at the beginning of the class, that I put on for a 10-cent debit. Okay, I didn't get it on for even. I didn't get it on for credit like the example I'm showing. It cost me a net 10 cents. Okay? It beats buying a naked put for $16 or $20 in the SPX, or even a spread for $1.50. This cost me 10 cents. Right now, when when I started this class, the SPX was in between the strikes. I took off half of the trade yesterday for a $1.70 credit. That cost me 10 cents to get into. And I've been dealing with the last 10 contracts of how much can I squeak out of this? Okay, it was a little tiny position, but I can make up to $5,000 on the last 10, and I made 1,700 on the first 10 contracts. So I can be making $6,700 on a $200 trade. Now, is that big enough for our portfolio? Is what people are going to be asking. Well, no, that in itself isn't enough. Okay, when we're carrying 200 long deltas or 150 long deltas and the market's falling this much, I'm going to need 3 or 4 types of these trades where I can make $6,000 here, $6,000 there, $6,000 there to make back all that I can lose in a market that's falling this much. But I do have on that many. I just diversified it over different expirations for illustration purposes in the pot class, Whereas in the past, I've been stacking them up in the same expiration. I love stacking them in the same expiration, like have everything in December 24th. It makes, for me, managing the trade easier. But for people who are just learning the strategy, it sometimes makes it more difficult to understand. And the reason it makes it more difficult to understand is I'm buying and selling the same strikes sometimes. I'm buying one spread at certain strikes, and then I'm using another spread, another layer that's using the same strikes and canceling them out. And people are like, wait, it just disappeared. And I'm like, no, it's synthetically still there. Okay, it's just moving everything around, and it starts getting confusing for people. I'd say maybe 25% of the people, when I start stepping on the same strikes multiple times in the same example, about 25% of my students are like, get confused. Wait, you bought the 2700 put, now you're selling it, and now you're buying it again. Are you just scalping this? I'm like, no, it's a different layer at the same strikes, and it just they become frustrated. And so this expiration or this particular sell-off, a lot of students said, can you do it in different expiration cycles so you're not stepping on the same strikes? Maybe I'll understand it better that way. And like I said at the beginning of this, whatever my students ask for, we do. I mean, this is the most democratic process there is, in that I don't come into any pot class with any, I guess, agenda. Once in a while, I'll say this is important enough where we should be talking about this, and I'll just create the topic, because people may not have even heard of the strategy, but a good portion or the majority of the pot classes are topics students came up with. They say, well, look, I got all these butterflies on, they keep going out worthless. What can I do about it? And then we'll create a pot class about it. Or I keep selling put spreads, to get long stock, but the stock keeps falling through all the put spread strikes. What can I do about it? And that'll create another class, another thing. And so most of our pot subjects are brought to us by the students. And so when the student said, can you do a rolling thunder in several different months? We just did it that way. Personally, I prefer it all to be in December 24th expiration, and just create a giant circus tent where I keep expanding the height of the tent and the left and right distances of the tent. But it does get confusing. And so this time we did things a little bit different, but I'm taking a piece of it off because we have a December 12th expiration on, and December 14th expiration position on, and December 24th expiration of rolling thunder on. So did that answer the question, or did I just make it more confusing?
No, I understand, because you get lots of layers, and then it starts getting complicated to look at it because there's so many strikes involved. So it makes sense that people want to split it up, but I can also understand why you want to keep it on one expiration, because it's easier to manage, I think.
Well, it's easier to manage, and it's easier for me to understand. And if I'm looking at a P&L graph, my $10,000 or $15,000 potential profit becomes elongated, where it goes through 2,700 down to 2,500 in the SPX. And I say, wow, I have 20,000 profit potential from 2,700 down to 2,500. If the market falls below 2,500, I better get something else on. But throughout this entire range, I have 20,000 profit potential. That's a pretty decent range. Then I can ask myself, is that adequate protection for my deltas? Or if I'm delta flat, I could actually start bottom fishing here without fear of getting stabbed by the falling knife. right? I could make a stand and say, look, I got all this profit potential here. I think this is the bottom. Why not get some long deltas here? If I'm wrong and the market keeps falling, my rolling thunder will eat up that loss. But if we bounce from here, how cool is it being the only person buying down here when the rest of the world's been long since 2900? Just a different way of looking at it. Everyone's got their own way of looking at the market. And that's the great thing about the rolling thunder trade is it affords you the flexibility to have your own personality and agenda.
I guess we had one last question of what is water? Maybe you could just give a quick 30-second overview.
Oh, water is a that's a great question. Water is a advanced version of a book I've written previously that is going to have more examples and is somewhat outdated because the examples were a lot of them in the OEX and no one trades the OEX anymore. So it's an updated and advanced version of a previous book that is how to maneuver around positions that are making money or losing money. It's a fluid way of managing, especially losing trades. And that's something that nobody likes talking about, right? Every single education firm says, here's a call spread I bought for $1. It's now at 3. How do I deal with it? And everyone's like, oh, this is exciting. But that's only half of trading. Half of the time you're going to be losing money and you want to know, how do I minimize the loss? Now, you can't take somebody who's been shot by a gun, take them to the ER room, and have them walk out good as new. Worst case scenario is they'll come out of the hospital with a scar where the bullet hole is. But how do you save that person's life? And that's what water is. Let's say you buy a call spread and the market starts going against you. How do you minimize that loss? How do you take a trade that you bought for $1 that's going the wrong way, get most of your money back so you don't have a total loss, but yet leave on opportunity to make money? And I guess the easiest way the way I've previously described is, let's say you have a winner. Everybody's had a winner. You buy a call spread for $1, it's at $2, but it could go to 5. As soon as you buy a call spread for $1, it goes to $2. You get this mixed emotions going. Some of you says to yourself, wow, I bought it for $1, it's at $2. I better take this profit and run before I give it all back, because too many times I've had winners on and then gave it all back and it became a big loss. The other half of you is saying, you know what, it can go to $5. I'm just going to let it ride. And you're struggling back and forth. Do I take my profit before it becomes a loser, or do I get greedy and try to make the full $5 on the trade? Water is a way of taking off some of the profit and leaving on a huge amount of profit potential so that you don't get into this binomial mindset of it's either going to be a total loss or a total victory. That's on a winning trade. The losing trade is always, is similar in that you bought a stock at 100, it's at 90. Do you buy more or do you take your loss and run? A lot of people sit there and say, well, if I take my loss and run, I've got no chance of making money back because I'm out of the trade. And they stay in the trade forever and create a bigger and bigger and bigger loss. Water is a way of showing you how to adjust where you can then take a bad position, put a tourniquet on, stop the bleeding, but leave something on to still make money later on. It's a huge undertaking because the amount of possibilities becomes very complex and complicated. You start creating this giant web, and it's easy to confuse people. You have on the call spread, well, I can turn it into a butterfly. What does this look like once it's a butterfly? I can turn it into a condor. I can hedge it with this put spread. I can do, and you go through all the possible combinations, and then at the end compare and contrast so that you show the best example. And it takes a lot of work to write something like that. It's a much more complicated book to write than what's a collar.
Yeah, a lot of possibilities.
It's literally limited by your imagination, because you say, well, I got 10 call spreads, I can sell 10 call spreads against it and make a butterfly, or I can sell 10 call spreads and make a condor. But what happens when you start playing with the quantities too?
Yeah, 9, 8, 7, 6, right.
I mean, the possibilities are unlimited, and it becomes a very, very slow book to write. It's an important book. That's really what, as a market maker standing in the pits, we were doing all day long. That was different than the general public. I had no more winners. When I was on the trading floors, I didn't have any more winners than anybody else. Probably some people listening in were better at predicting the market than I was. I may have only been right 45% of the time, and some of your people are probably right 55% of the time, because they're good at charts and reading the trend and everything else. But where I became profitable, whereas somebody else is losing money, is not in being more right, but what I did with the trade once it was on. How did I minimize my loss and maximize my profit potential? And that's water.
Sounds great. Looking forward to it. Well, Scott, we're already over an hour and a half. Normally we only go an hour, so we had good discussion, so I thought we should keep going. But
well, I'm a filibuster. I should be in Congress. I can say a lot.
That's okay. It's a good content. Everybody enjoyed it. Everybody's still here, so he didn't lose anybody, so that's great.
Well, you guys, you've always had a great crowd, and everybody that's come from you, Tom, has been nothing but great. They've been very nice and polite and appreciative to me and my staff, and I want to thank you and everybody at Airmer.
Oh, you're welcome. It's just me at the moment. Hopefully I'm going to hire somebody in 2019, but for now it's just a solo.
I've got a lot of back-end help, so if you run into problems ever, and you feel free to contact Glenda and say, can you get somebody to help me with this, and you can borrow some of this is my crew. All
right, it's a big crew.
So I'm pretty much 24 hours a day, because we're in Europe so much now. I mean, I'm in, I don't know, 16 countries now.
Wow, that's great.
I think I've done more classes in Italy than I have in the United States in the last 2 years.
Oh, and there was a question, where can they find the recording? I will post it on our YouTube channel and also in the Airmer library, so there'll be lots of copies of it floating around. I'll send you a copy if you want to use it too, Scott.
Okay, great.
All right, well, thanks everyone for joining us. Scott, especially, a great presentation. We're glad you could make it. And we look forward to more in the future, and hearing about your the water and the webinar you got, or the seminar you got coming up. And again, I can't recommend the Rolling Thunder book highly enough. It's I consider it a must read. So hopefully people can, if you don't have it, consider buying it. It's give yourself a Christmas present.
Yeah, it's and don't forget your discount code.
Great. All right, Scott, have a great holiday, and everyone else too, and we'll see you next time.
Thanks so much, guys, and thank you, Tom.
All right, bye-bye.
Bye-bye.